Are we? Where's...
Hi, David.
Hello, Errol.
I see we
I'm
just
just
still have a
checking
few.
it out. Can you hear? Okay.
Yes, can hear you perfectly. Can you hear me okay?
Fine, fine, fine.
Great. Welcome to everyone who's joined already. If you just give us a few minutes, we just still have a few people joining. So just another minute or two while we wait for them, and then we'll get started from there. Thank you very much. All right. Good afternoon, everyone. My name is Errol Zeki, and I'm the Chief Executive Officer at Sasfin Wealth. So on behalf of Sasfin and AIMS, I would like to welcome you to the launch of the Sasfin Personal Share Portfolios on the AIMS platform. Now, this is a collaboration which is probably close to 18 months in the making. So, from my side, or from Sasfin's side, we're exceptionally excited by the opportunity. Sasfin really does have a very long and rich history when it comes to managing portfolios. Sasfin Securities is one of the oldest members of the JSE in sort of various forms and guises, I think going back to as far as 1890. And we haven't just stuck to local. Over the years, we've made a very deliberate move into a more global approach to investments. And today, we offer a very diverse set of local as well as global solutions and across asset classes. At this stage, I know, many of our collective investment schemes have been available on AIMS for some time now. But today is all about going back to our roots, and our roots are very much offering investors with bespoke managed share portfolios and high-touch relationships. So to start with, in terms of the AIMS relationship, we'll be launching with local share portfolios, retirement annuities, as well as preservation funds. And in terms of the RAs and the pres funds, you will be able to take the permitted 30% offshore to be managed there in a separate portfolio. We're working very closely with the AIMS team in terms of making full offshore discretionary portfolios available as well. So watch the space. We really hope to share more about this in the not too distant future. And then I have my colleague, David Shapiro, here today to just really present and provide his overview of how he sees the world of investments right now. He's the Deputy Chairman of Sasfin Securities, and he celebrated his 50th year of working last year. So that's really 50 years of direct experience on financial markets. So thank you very much, David. We probably won't have time to handle all questions today, but if you do have any questions, please post them to the chat. We have the distribution of all the participants. We will make sure that you get those answers and that those are replied to personally back to you. But before we get there, I'd just really like to extend a very special thank you to Sean Watkins and the team at AIMS for the opportunity and for all the hard work to get us to this point. If I haven't already said it, we are truly excited about this association. So before we move to David's presentation, I'd just like to hand over to Sean to say a few words.
Good morning, everybody. I hope that you can hear me clearly. Errol, thank you very much. I really appreciate the opportunity. Yeah, it's been 18 months in the making, and let's hope that we build a fairly lucrative and good relationship going forward from here on. I'm going to just bring my presentation up onto the screen. If you can allow me the opportunity. And I'm not going to start at the thank you part. Let me start at the introduction. So I wanted to talk to you about can somebody please indicate to me if you can see the screen?
Not yet, Sean.
Okay, just give me a moment quickly. Apologies for that. Technology, everything worked before I started the presentation. You should be able to see the presentation now.
We can see it. Thank you.
Thank you. Thank you. I thought rather than going into the typical platform conversation, I would like to share some experiences over the last few months with you with regards to the platform, because that will also give me a nice segue into taking you onto the conversation around share portfolios on the AIMS platform. So I thought a good synergy or good terminology would be the grey swan terminology, and I think that was very applicable to the platform world in South Africa. Everybody anticipated this. Everybody thought it was possible, but then it happened, and it had massive impacts on all of us. The first one is obviously the economic impact from a platform perspective. We saw on the 26th of March, when lockdown level 5 was announced, we saw a gradual decline in assets across the platform industry, the investment industry, and on the AIMS platform, our assets most probably dropped about 6 to 7% in valuation, which we were very fortunate about, because a lot of platforms and other environments most probably dropped much more, because our typical type of financial advisor, the much more conservative type of advisor, and they invested more into the income and cash type of solution. So the drop was much lower. Well, forward 5 months later, fortunately for us, we are up 3% in assets from the period when the COVID started, and we look forward to a good growth period. Over the same time, we saw a lot of changes from the regulator. Platforms had to scurry, as was all other areas in the financial services sector, to adopt all the new regulations, which was published, gazetted basically on a weekly basis. A lot of effort, a lot of systems development has gone in across the industry in platforms to make sure that we could accommodate for that, and similar to that on the AIMS platform. Well, COVID-19, I think it forced us all into a technology world, as well as thinking differently, thinking a little bit out of the box in terms of how do we deal with our clients and what type of service we provide our clients and our financial advisors. And if you have a conversation with our business development managers, you'll find that we've actually made it very easy to deal and to do business with us over the period. We also believe that it's changed the whole landscape in terms of how do you provide services into the industry, and we don't suspect that with any of those type of services that we put in place, as well as the process enhancements that we put in place, will change going forward. I think a challenge that all of us have, and the portfolio managers have, and most probably David will talk about it, is that we need to provide advice, or you need to provide advice in a low returns environment. That's a challenge, because I think that the story and the expectations of your clients have not changed. They still expect 6 or 7% returns in cash, while cash has gone down to 4.5%. And it's really a difficult story to sell to clients out there. And we see that even though clients are moving their investments into the cash world, it doesn't mean that it's a safe environment, because it's a declining performance environment currently. And we suspect that most probably will be the picture in the short term. Client anxiety. Well, I've never seen so many complaints from clients, and the complaints is not about bad service. The complaints is about I want my money, I want my cash now, I'm battling to survive, I can't pay medical bills, please pay me now, etc. We've been very lucky that we, through the period, I have got the whole platform all working from home, 152 people. And during the period, we've maintained a 90% service level plus within our transaction processing and our call center environments. We also had our business development teams out there and our service relationship management teams out there engaging very closely with financial advisors, with clients, and where we can, we have really gone out of our way to assist. So I would really invite you to come and experience our service and what we've done during this period. To move on to the Sasfin portfolio, and as Errol share portfolios, as Errol has pointed out, we've have 2 share portfolios available within our living annuity and our retirement fund range. The minimum investments into those portfolios is R1 million, and we charge our standard platform fees for administration, and we do not charge an additional fee in administrating or administering any of our share portfolios, and that goes for the Sasfin portfolios as well. Lastly, we believe that the relationships is very important in our industry. This is a relationship industry, and we found that most probably this is the thing that sort of took us through the COVID period. It helped us to grow our relationships with our financial advisors. It helped us to grow relationships with clients where we had access to clients. And I believe that it is because we've put together a personalized and a very specialized services model. So from a transaction processing perspective, we deal with our client servicing on a hub basis. So we try and keep it regionalized. We try and get our financial advisors to know who the people are that they are dealing with, so that they can have personal interaction with them and learn how they do all the way. We've got a service relationship management team in each one of the areas. So we've got people that, we understand that things go wrong. We understand that everybody can make mistakes and errors, although all of us, I think, aspire to keep it as low as possible. But then my view is if those things happen, is how quickly can you recover from it, and what type of service can you provide to make sure that you actually deliver to the needs of the financial advisor and the clients. And therefore, we've put in place a service relationship team. We've got 8 regions right across the country, and I think this team delivers an excellent service. We've got a business development team. We've got 15 business development managers placed right across the country. Their goal is to assist you in providing solutions to your clients. So in the case of Sasfin, they all have been trained on the Sasfin portfolios. They understand the outcomes of the Sasfin portfolios. They understand who to go to, where to get information. They understand how the quotes work. So please engage with them. Engage with them to find out more about our services. Engage with them to find out more about what we do, our pricing, and how do you go about doing business with us. Lastly, in place, we've got a regional management team in each one of the areas. Alma, Johan, and Richard, who heads up that team, is fully available to you all the time. And obviously, if there's any problems, I am more than welcome to take any calls and to assist you to make sure that you get the service experience that you need. Errol, I think that is my 10 minutes. Thank you very much for the time. Thank you very much for the opportunity. And I'm looking forward to a good and prosperous working relationship between us.
Thank you very much, Sean. We're also very excited. So, David, are you on the line?
I am. I'm here.
Great. Thank you very much, David. Over to you.
Thanks, Sean. Thanks, Errol. I'm just going to rattle into it. I don't want to spend too much time, but you know what Sean said, which is so true, is that clients are still expecting what we used to get in the past, a plus 6% or wherever. You can't get that. We're in unconventional times, and therefore your approach to managing portfolios has to be unconventional as well. You've got to move with the times. I've never believed in being a person that's packaged oneself. I'm not a value investor. I'm not a growth investor. I'm just an investor. And as I've explained to people at the firm, this is not the kind of market that you can just put onto a GPS. You actually have to manage each kilometer that you travel, watching out for potholes, watching out for anything that might obstruct your journey. So you've got to become very vigilant in these kind of markets. I'm going to recap on where we are at the moment. I think it's quite important just to take a look at where we are, and I'm going to end with what Sean has said. Just how do we look at portfolios in these unconventional times? Where are the opportunities? If you go back 4 months ago to end March, that's when the market spooked us. At that stage, we were worried that the market was too low. What's happened 4 months later? We're still struggling with this pandemic. We still haven't come out of it. But what's a big worry now is that markets are too high. We've been through a very, very frantic time. And as I said, we're not out the woods. But each day we're getting closer to the end. We're getting closer to the end of this pandemic. But to be honest, we're not getting closer to the end. We're probably getting closer to the beginning of a new way of looking at things, a new way of living, a new lifestyle. We've spoken about it a lot, and I don't want to cover this kind of ground about what our lives are going to be, walking around in masks, not wanting to touch people, not being nervous at work, staying at home, and so on. I think it's been covered in great detail. But it's very interesting to look at markets. If I'm just going to use the S&P 500 as a proxy. When we started at the beginning of the year, the S&P was around about 3,230 odd. We reached a peak in February of 3,373. We fell in March. In about 2 or 3 weeks, we dropped about 40% to that bottom around about March the 23rd. And subsequent to that, we've recovered all ground. And last night, or on where we now, Friday, I think Wednesday or Thursday night, we reached 3,373 again. So we're back at the peaks. On an overall basis, we're up about 4.5%. That's the S&P. So it's quite a remarkable recovery. The speed at which it's recovered has been quite remarkable as well. And if you look at the NASDAQ, which is very tech heavy, that's actually up about 23% versus the S&P is 4.5%. So you can see the difference. And of course, the NASDAQ driven by tech shares. We've had Tesla up 280%, Zoom 200%, NVIDIA, which is a semiconductor company, 95%, AMD, another semiconductor, 78%, and so on. Amazon, 71%. Massive, massive gains in some of those companies, and for good reason, for valid reason. because those businesses have actually helped us through this pandemic. If it wasn't for Facebook, if it wasn't for Amazon, if it wasn't for the gaming companies, the WhatsApps and various other applications, we would not have survived this. We would not have survived without Netflix or Disney, the streaming side of it. So there's valid reason why this has happened. If we look at the other end of the market, of course, you've seen a massive collapse in banks, in airlines, in energy stocks, in retailers, travel stocks, and so on. Obviously, those that have been hit by the close down of the global economy. So that's what it looks like. In fact, if we look at South Africa, first, when we look at the JSE, remember the rand has depreciated 20% or 25%, whichever. If you want to look at it in rands or you want to look at it in dollars, we're down about 25%. So that's given us a boost. So when we do look at the JSE, even though we've recovered all the losses and we're back where we started, we're up now 1%. If you look at it in dollar terms, we're still down about 20%. But be that as it may, it's been a remarkable recovery in the JSE as well. And that's been driven by gold shares. Gold's been huge gains in gold fields, about 140%. Some of the lesser ones like Durban Deep and so on. Also, and this I must point out, BHP, we've ignored that, up about 26%. And I'm going to come back to that a little later. But the big winners at the top end of the market have been Process and Naspers, obviously, because of their exposure to Tencent. Tencent's numbers were out during the week, and they were spectacular. Despite all the issues that they're facing with problems in America, it was still a spectacular result. And I urge everybody who is interested in the market just to go through the numbers to see the breadth and depth of the business, and where you have 1.2 billion monthly active users. You know the size of this company. But of course, on the JSE, Process, Naspers, gold shares, if you were in retailers, leisure, banks, and so on, it hasn't been a pretty picture. There's been a lot of disaster around, and for obvious reasons. You can see through the results that we're getting that things haven't been that great. So why are we up? Why has this happened? It's not easy to understand. I don't think there's one valid reason. You can put a lot of reasons around why markets have recovered as frantically as they have. But when we went into the downturn, and clients asked me what we were doing, I just, having been through so many ups and downs before, admittedly, each one has a different characteristic. But having gone down so far, I just said, no, I'm going to sit this one out. Why? Because I joined the market in 72, and I've been through the 76 Soweto riots. I've been through the 87. I've been through so many ups and downs as well. And every time I found that share prices actually went up afterwards. They recovered, and much faster than we thought. And this, and for that reason, I just decided to sit it out. Admittedly, it wasn't easy. I bit my nails down to my elbow, but especially when you're handling clients' portfolios. But it's kind of paid off, just simply because of what history has told you. And what I'm trying to say is that I think people are resilient. People are resilient, and they adapt very fast to conditions. And if you think of us now, we don't look at the body count anymore. We don't look at the bags that are coming out of hospitals. We don't look at the infection rates. We're focusing on the solution. We're focusing on vaccines. That's beginning to shape the way that we're looking at. We're not scared of a second wave at all. We know we can handle it, etc. And also what's happening is medical people are learning a lot more about the virus. Each day, they learn more how to treat it. Mortality rates are falling. So we're getting over it. It's not the threat that it was. We can't wait to get back to our normal life. We're starting to see economic life start to improve, particularly in the Asian economies. China, I don't want to say it's full, it's back to where it was, but it's getting there slowly, and it's coming through in quarterly numbers. It's coming through in the economic data. Even if you look at employment numbers in the US, yesterday we had the unemployment claims for first-time unemployment were down below 1 million, which was better than the market is expecting. Unemployment numbers have been okay there. So slowly, I'm saying slowly, economies are starting to improve. When we do get out, there's going to be an economic explosion. There's a lot of pent-up demand and a lot of inventories that have to be rebuilt. But of course, the big factor the big factor that has actually improved or got us going has been the massive course that central banks have followed and governments in order to stimulate economies. They've put huge amounts of effort. They don't want to go into a deflationary cycle. They don't want to go into depression because they know that they'll never get out of it. So they're doing everything they can to ensure not only does this tide us over this pandemic hump, but also that there's enough stimulus to keep the economies accelerating once we do come out of it. And I think that's probably been the biggest driver. Of course, it's caused all kinds of discussion, and you can hear, 24 hours a day. This is a reality show of every economist coming in and chirping about what this is going to mean down the line. I haven't got the intellectual power to understand it. I just watch the market going up and up as it's fueled by this liquidity. So if you do want to enter that, there's plenty of opportunity to look at what this is going to mean. But in the meantime, if they don't do it, we're going to go into an economic slump. That was last witnessed probably in the 1930s. So naturally, those kind of policies, what they've done is that they've brought interest rates down to zero. In developed countries, I'm not talking South Africa, interest rates are zero, and we're going to stay at these kind of levels for a long time. What's also happened, if you look in the US, and I'm using this as a proxy, there's negative real rates. Negative real rates means if you look at the 10-year bond, I know it's been picking up a little bit over the last couple of days, gone up from 0.5 to 0.7. Now we're talking decimal points, but inflation, which is also read recently in the US, came in at 1.6%. That means you're in a negative 1%. What do negative real rates mean? It means that your money is losing its purchasing power all the time. You're getting poorer by 1%. If this continues all the time. So, of course, that's brought people into the equity markets simply because certain equities are doing pretty well, particularly in the in tech. And we understand that. Last week we had Apple's results. We had Apple, we had Amazon, we had Facebook, we had Alphabet's numbers. They were spectacular, and it just shows you what powerful businesses these are. So the big question that people ask about this, about the tech numbers that we've seen and those NASDAQ numbers, is this a bubble? This is a bubble. Yes, this is a bubble. No, it's not a bubble. Where's the bubble? If tech is a bubble, then what does the bond market at minus 1% real mean? That's a bubble. So you've got to choose. Which bubble do you want? The tech bubble at minus 1%, or do you want the tech bubble at, 22 PE or 25 PE versus traditional 22, whatever their measures are, or do you want to go into a minus 1% real return, which is in the bond in the bond market? So, from my point of view, yes, valuations in tech shares are stretched, but I don't think to a point where they're likely to collapse. And don't compare it to 2000, because back in 2000, these companies weren't earning money. The one thing about tech shares today is they're spewing out cash, and those are the kind of companies we need, who don't have to go to banks and borrow. And what about the gold market? That's not a bubble. I mean, what is the price of gold? It's a fear factor. It's a price that everybody wants to pay. I know we can make all kinds of intellectual arguments about gold, but at the end of the day, you buy gold hoping that somebody is more nervous than you and is going to pay a higher price or drive it up. So these are all kind of bubble markets. But if for choice, I prefer the tech bubble than the other kind of bubbles. So I'm not going to go on for too long. But I do want to come back to what Sean said and look at the local market and try and get a feel for where we are. Because when you look at the products that we're developing or selling, many of them are Regulation 28. Some of them are living annuities where you do have a little more flexibility. But in South Africa, we're probably facing a massive investment challenge. The economy is under huge pressure. I'm merely reflecting. I'm just the messenger. If we looked yesterday, we had mining numbers out, we had manufacturing numbers out, we've had all kinds of data that's coming out, retail numbers and so on. which are going down on the base, we're actually compounding downwards. So we are facing very tough times. Do yourself a favor, go look at the First Rand's results, their trading update. You can look at Absa as well. You can't hide the fact. I haven't looked at the numbers, but each bank is facing similar kinds of conditions of slowing top line, of consumers and companies under a lot of pressure, forcing bigger impairments or bigger provisions and so on. So things are not easy, and there are a lot of challenges. So what about clients who can't get their money out, who can't do an asset swap? What do we do? There are opportunities, and what I was trying to say is that in these kind of times, you have to take more conventional or try and change your whole adoption or your whole approach to portfolio management. What we're doing, we're in those kind of situations where you're only allowed 30%. Of course, we go maximum 30% offshore simply because there's just better opportunities there. But one of the dangers that we're facing is that, and I sit on a very large pension fund as an advisor on that. And what we find is that where you're at 30% offshore and your local portfolios here, as this starts to fall, so you have to start selling off down your 30%. You have to sell the winners to pay for the losers and rebalancing. And that's something that I can't understand, but it's happening in local portfolios as well, where we're Regulation 28. But in the meantime, in that instance, there are a lot of products around. I personally favor some of the ETFs that we've got on the JSE. There's a new China fund, which you should look at. It's got a lot of companies. China is a growing area. There's Tencent in there. There's Alibaba. There's NetEase. There's a whole lot of new companies that we like. Ping An. I can't pronounce him, so I'm going to leave it at that point. But a lot of good growth companies there in the China fund. There's a Fourth Industrial Revolution fund. There are a number of funds, quoted on the JSE, that I find extremely attractive as entry points for that 30%. Just for the balance of equities, of course. Where do we look at? We've got Process, we've got Naspers. Yeah, you might be doubling down on Tencent, but still, both those companies, I think, well worth looking at full weight. And the one area that we've kind of ignored, and I'm not a gold man, but we're seeing with China coming through, you're seeing commodity prices picking up. The one thing that I've been following for the last couple of years has been the iron ore price. And everybody tells me that iron ore price is going to go down. I don't know what Absa's economists look at, or Absa's analysts look at, but I certainly know that the conventional wisdom says that the iron ore price is going to go down to 65 or thereabout 70. Where's it at the moment? 120. And it's been at 120. I think we reached a low when Vale was supposed to be coming back on full production. But since then, iron ore price remains very strong and seems like it's staying there together with other commodity prices. Oil prices are stabilizing. So suddenly companies like BHP and Anglo's looking fairly attractive as just to kind of support where we are on the equity side. What about the fixed interest side? And this doesn't only apply to Regulation 28 companies where you're looking for income and you're forced to put at least 25% into fixed income or property. It applies to a lot of our clients as well who are looking for income. It's a big challenge. Interest rates are falling, as Sean said, and we're likely to see interest rates coming down. We're down 3.5% already this year. There could be another 0.5%, taking it down to 4%. Of course, that's hurting things like preference shares or the short end of the market. Property has collapsed. And Redefine's numbers were out a day or two ago, 45% down on the distribution. That's going to be the pattern. As tenants fight for lower rents, as vacancies increase, as costs increase, as valuations come down, property, which has had a wonderful couple of years now, is going to be under pressure. It might seem very cheap for you at the moment, but I think it's going to take time before we start to see any kind of recovery in the market. So people who were relying on the very healthy and generous offerings that they were getting from property shares are likely to battle. So you've got interest rates falling, You've got property companies coming down. And what about dividends? The same thing. We're seeing companies holding back on dividends as well, cutting back on their dividends, conserving cash, offering shares instead. Even Richmond. Even Richmond is now giving you a 3-year warrant as well as they cut back. So for people who relied on that kind of income, things are pretty tough. No property, no short-term rates, and of course, dividends under pressure. So what do? So you have to, we've taken, and I say we, I'm talking about my little team and the people that I work, everybody's got their own views, but you have to take a different kind of approach. And what I find very attractive, and I know the risks, and it's something that we have to manage, is the long end of the bond market. You're finding rates anywhere from 10 to 11% clean yields round about there, which I find very, very attractive. Yes, I'm going to be challenged, about South Africa's debt position, and also whether these rates can spike up. I would rather, my own view is I would see the yield curve flattening. In other words, short rates going up and rates at these levels kind of remaining within the kind of range where we are at the moment. So we're putting clients into the long end of the market, finding bonds there very, very attractive, as a way to earn income. I've got out of property, we've got out of preference shares simply because rates are coming down there. We're out of the short end and rather focusing on that end. Another way that we've approached this, and it doesn't really apply to Regulation 28, with equity markets strong, and I think equity markets are going to hold their own and remain strong. What we have done to clients, I know it's unconventional, but we have to be that way. We've said to them, listen, put aside 1 year's revenue. Your income requirements for a year. Put away 1 or 2 years. Just put them away, so you've got your money. Leave the risk in risk assets, maybe in equities, whether you want to go offshore, or wherever you want to do. So we've taken that kind of approach as well, maybe 1 year or 2 years as well. But we've had to do that. The one thing we can do is markets allow you to do is to be pretty flexible. So I'm going to end off there. I'm just from a local point of view, just some warning sign. Just be careful. You don't have to rush in to the local market. It appears very, very low. Bank shares are low. From Absa, from First Rand. Retailers look very low. A lot of companies look very enticing at these kind of levels, but be very selective about where you go. Bottoms are formed over time, not over price. So let the bottom form. Let the bottom form. When conditions start to improve and you see the economy beginning to pick up, that's when you can come in. You don't need to rush in at these kind of levels. You've got plenty of time to make that kind of decision. So I say on equities, if you do want to go in, there's still the offshore, there are commodities, and certainly the processed ice bits remain very attractive. Just watch the iron ore price, watch the copper price. Errol, I'm going to leave it there. I've got to actually check out. We're recording the week that was now in about 5 minutes, so I've got to go on to another webcast. But thanks, and I hope that was valuable.
Hi, David. Sorry, I'm just quickly getting my video going over here. Can you see me? Yes, there you are. Thank you very much for those insights, David. We really appreciate the time, and good luck with your recording. I think Sean and I will stay behind. There are 1 or 2 sort of product questions, which I think between the two of us, we will do our best to answer. But before we get to that, just to say once again, to Sean and the team at AIMS, thank you very much for this opportunity and this partnership and the effort to get us to this point. But most importantly, thank you to all of you for attending and listening to our story. As Sean said, please engage us and find out more about these personal share portfolios. We are a relationship business, and we're here to assist you and partner with you as we sort of navigate these very much interesting times that we are currently in. Sean, I just saw that there were sort of a few questions around offshore living annuities, those kinds of things. Is that something that you would like to answer? I'm happy to talk to some of that detail.
Errol, I'm just going through it. So I think so. So let's maybe about the offshore proposition. So obviously that is one of the shortcomings that we have, and we recognize that. and we're currently working on it, and hopefully we can make some progress and give some good feedback on that in the near future. On living annuities, I'm just trying to scan through the questions. Errol, if you can just maybe help me.
Certainly, I think the question was really the living annuity question also related to offshore. So, living annuities obviously don't have the Reg 28 restrictions, but my understanding is that we don't have a full offshore capability for living annuities as it stands, but that the 30% of the compulsory, being the retirement annuities and preservation fund, certainly can go offshore.
Yes. Right.
I'm just looking at the questions, if there's any more product questions. And then, I mean, there were just sort of a few questions that just came through on risk profiling. And just to say, this presentation was now a very equity-focused presentation, but it certainly wasn't, our indication is certainly not that there shouldn't be a good asset allocation overlay in terms of building a solution for clients. I think from a risk appetite, someone's willingness and ability to take risk is definitely something that needs to be taken into account in all of this. And from an asset allocation perspective, if you look at what fixed income, for example, has done locally over the last few years, it's been a great place to be. So even within a Reg 28 construct, there certainly have been some pockets of excellence locally, together with some of the Rand hedge counters. Just to talk to that one question.
Yeah, Errol, then also I just want to pick up on the question that Francois asked, and I sort of, or the comment he made rather. I think that the challenge that financial advisors have is that their clients are expecting, as David said, the returns of even 6 months ago, and those returns are just not there. And I think, and we're busy writing a few articles on it, which hopefully we'll bring out shortly. Is just, I think we need to start playing an education role as well as financial advisors, and guide our clients through this time, and make them understand that the narrative have changed for the short term, most probably the medium term as well. We predict this will at least last another 18 to 24 months, most probably, and I think that if we educate them, we're also going to see that we will get them to trust us as well, because I think sometimes a bit of trust is lost. And I take it, if 40% of your portfolio is wiped out, and you're 65 years old and you need to make 70 plus, you are going to run out of cash somewhere down the line, and hence that creates a lot of anxiety.
Sean, I completely agree with that. I guess just the overlay on that is, of course, is that's not a justification to take on too much risk or additional risk. And also, one very subtle point to also make, I think, just in closing, which covers a lot of the questions that have been asked and covers a lot of what David said in his presentation, is the importance of staying invested. Anybody who was trying to time markets this year or panicked out of the markets in March, no one was expecting, for example, US markets to recover to the extent that they have, property stocks locally to do what they have, etc. So I think just a very consistent and important message to clients is not to try and time, to stay invested, because it's the long-term returns that are ultimately going to help someone reach their long-term investment goals. It's not about the short-term movements in the market. It's not about trying to time them in these uncertain times or during the volatility. It's very, very important to look through it.
Yeah, agreed.
Well, I think we're going to close off there. I don't see any more questions. But please, just to reiterate, please engage us. We are a high-touch relationship-based business. We are here to assist you. We're here to partner with you. We're very excited about this opportunity. And yes, we are working very hard to bring offshore to you as soon as possible as part of this offering. So thank you very much for joining us. Thank you once again to Sean and the team. And have a wonderful weekend, everyone.
Okay. Excellent. Thank you very much, everybody.